Monday, May 19th. From my Taylor calculator, I put in the numbers on my chart. Resistance at 59.90, support at 59.39. So the range was 51 points for the day. I took those numbers and created a rectangle on my chart. Here we are, 9:30 open, 4 p.m. close, New York market. And this is the S&P E-mini chart 3-minute candle. And so 9:39 down here, 9.90 resistance, and Friday's close was right over here at 9.75, 59.75. And so prices opened at 8:30, or prices were trading at 59.10. Now Monday, more often than not, Mondays are positive days. And so with prices trading well below the trading zone and the previous close well above the trading zone as well, and Monday being a day where the market tends to favor positive days to the upside, it was likely that prices were going to trade into my trading zone and hit the previous day's close. And so let me take you through the day. How about that? Who would have believed it? Who would have believed it? But for me, just having a visual representation of where prices are likely to trade, that's worth something. I don't know about you. But to me, this area of pre-calculated estimate of where prices are likely to trade is very reassuring. And of course, using the previous day's close as a target as well, also reassuring. So that's my video for today. I think you find it rewarding if you use the technique that I've been talking about so much in my previous videos. Thanks so much for watching. Marv Eisen here from Time to Dollar, and I'll see you in my next video.